Financial Reporting Quality. This reading has 5 sections: an introduction where we'll talk about the concept of financial reporting quality and earnings quality. Then we will discuss a conceptual view of financial reporting quality and show that financial reporting quality can be thought of as a spectrum. Section 3 gives us as analysts a context for assessing financial reporting quality. Section 4 deals with the detection of financial reporting quality issues, and Section 5 is a summary of the most important points from the reading. Let's get a basic sense for what we mean when we say financial reporting quality. A high-level point here is that obviously many companies report their financial results, and the quality of the financial reports varies a lot from company to company. So what do we mean by high quality financial reporting? High quality financial reporting provides information that is useful to analysts in assessing a company's performance and prospects. Low quality financial reporting contains inaccurate, misleading, or incomplete information. An important point to note here is that when we say financial reporting quality, we are not talking about high earnings or high equity. What we are talking about is how well is the financial information presented. In other words, with good quality financial reporting, the numbers presented or the reports presented will give a good indication of the underlying economic reality. A related concept is the quality of reported results. This is also sometimes referred to as earnings quality. So what does high earnings quality mean? High quality earnings result from activities that a company will likely be able to sustain in the future and provide a sufficient return on the company's investment. Two major items to note here. When we say high quality earnings, the first important item is that high quality earnings means that the earnings should be sustainable. Just because the earnings are high in a given period, but let's say that these high earnings are because of accrual based earnings, let's say a high accounts receivables, so high sales and high net income, but we do not expect similar high sales in the future. What is going to happen to earnings in the future? Earnings are going to come down, so the sustainability is low. We would then say that the quality of earnings is low. The other aspect is provide a sufficient return to the company's investment. Obviously, funds have been invested in the company. There is a cost associated with those funds that is called the cost of capital or the cost of funds. The earnings should be high enough that the return that a company is receiving or the return for investors should be higher than the cost of funds. When that is also happening, then we can say that we have high quality earnings. We've talked about the fact that financial reporting quality can vary a lot across companies. The lowest quality reports contain information that is pure fabrication. At the other end of the spectrum, high quality reports contain information that is relevant, complete, neutral, and free from error. And this statement actually comes from the conceptual framework that you studied early in your FRA education. We'll now connect the concept of financial reporting quality with earnings quality. If the financial reporting quality is low, then this makes it difficult to evaluate the financial statements and hence difficult to evaluate earnings quality. And this is how the curriculum expresses it. Low financial reporting quality impedes assessment of earnings quality and therefore impedes valuation. Obviously, high quality reports will make it easier to assess earnings quality and therefore make it easier to value a company. Now, these two statements make it clear that if the financial reporting quality is low, then it becomes difficult to even start assessing earnings quality. So the discussion of earnings quality really matters or is relevant when we have relatively high quality financial reporting. Now, given that we have high quality financial reporting, the earnings quality or the quality of reported results could be low or high, and this again is a mini spectrum. We've mentioned earlier that low quality earnings means that earnings are unsustainable and relatively low compared to the cost of funds. High quality earnings would mean that earnings or the return that investors are getting are relatively high and the earnings are sustainable. In other words, we expect relatively high earnings to continue in the future. We can combine the concepts of financial reporting quality and earnings quality to create a spectrum. Simplistically, the best case scenario is that the quality of financial reports is high and the earnings quality is also high, and that is depicted right here, the top left part of the spectrum. This is how the curriculum puts it. GAAP or generally accepted accounting principles are being followed. The information is decision useful, sustainable, and the returns are adequate. Let's understand each of these points in more detail. GAAP or generally accepted accounting principles is being used generically here, and this implies that the accepted accounting principles for the particular jurisdiction are being followed. In the US context, this would be US GAAP. In most other parts of the world, this would be IFRS. Decision useful is extremely important. Simplistically, this is saying that the information that is being presented should be useful in terms of making decisions. Now, what does that entail? The information must be relevant and material. Again, if you recall from your early readings in FRA, when we say material, we are referring to information that is useful in making decisions. So that's an important aspect here. Other attributes of the information that is presented should be that the information is comparable, the information presented should be verifiable, it should be timely and understandable. These two elements, the first two items in this box, really connect with the quality of financial reporting. The other items, sustainable and adequate returns, connect with earnings quality. As we've discussed before, sustainable means that the earnings numbers are likely to continue into the future. And adequate returns means that the return on investment is relatively high, and in this case it would be relative to the cost of capital. So if earnings are sustainable, earnings are relatively high, and the information is very useful in making decisions, then we are at the top end or the most helpful end of the spectrum. In this case, the valuation associated with a company where all these hold true will be relatively high. One step down is this item, GAAP. So generally accepted accounting principles are being followed, decision useful, but there is a question about the sustainability of earnings. In other words, it appears that the earnings quality is low. So using the same symbols that I have used earlier, the quality of financial reporting is high. In other words, the information is being presented well, it is decision useful, the accounting principles are being followed, but the earnings quality is relatively low. Perhaps there is a very high accrual element in the earnings numbers, which leads an investor to believe that the earnings numbers will not continue to be high in the future. So this means that the earnings quality is relatively low. The curriculum gives a good example of low earnings quality. In the first quarter of fiscal year 2014, Toyota Motor Company reported a surge in operating income. In fact, operating income increased by 88%. But this increase was largely because of exchange rate fluctuations. Toyota is a Japanese company and most of Toyota's sales happen outside Japan. The increase in operating income expressed in yen was primarily because of changes in exchange rates and not because Toyota was selling more cars. Now this is not sustainable. Therefore, we can say that even though the earnings were high in this particular quarter, but earnings quality would be low because it is not sustainable. As we travel further down the spectrum, the next item is within GAAP but biased choices. So this is saying that accounting principles are being followed in letter, but perhaps not in spirit, because the choices that are being made are not properly reflecting the economic reality, the underlying economic reality. Let's understand biased choices in a little more detail. One aspect of biased choices is aggressive accounting, where a company tries to show that the current period's performance is better than what it actually should be. A very simple example is to understate depreciation. We'll see this in more detail later, but take a situation where the depreciation expense should be, let's say, 100,000 for a given period, but the company decides to depreciate over a longer period than is appropriate and actually shows a lower depreciation expense of 80,000. This will make the earnings number for the current period look relatively better, and that is an example of aggressive accounting, which is biasing the earnings number. Another aspect of biased choices is with respect to the volatility of earnings. What some companies do is smooth the expenses or smooth the earnings numbers. And finally, there might also be a bias in how information is presented. So positive information might be presented very clearly and conspicuously, whereas negative information might be presented in a way that makes it difficult for analysts to understand or read. The curriculum gives the example of a company, Thakar, where this third sort of bias exists. What the company does is it doesn't clearly show segment information related to its sales, and that would fall under this third category of presenting information in a biased manner. Moving further down the quality spectrum, we have within GAAP, but earnings management. Earnings management is sometimes written as EM, and here is the definition given in the curriculum. Earnings management represents deliberate actions to influence reported earnings and their interpretation. At a high level, earnings management, where management is trying to influence the earnings, can happen in two ways: either real earnings management or accounting earnings management. An example of real earnings management would be where in a given period management cuts down the research and development expenditure so that the earnings for that period look better than they would otherwise appear. So this is real because the R&D has actually been cut and the earnings are actually better. But if cutting that R&D is not in the long-term interest of the company and it's simply being done to make earnings in a given period look better, then that is what is being discussed over here. The other item is accounting earnings management. Here, a company uses accounting choices such as the amount of depreciation or let's say bad debt allowance in order to influence the earnings number. This looks a lot like the biased choices that we talked about earlier. The difference between biased choices and earnings management is really intent. And since the intent is not always obvious, for example, perhaps there are certain biased choices which are taking place because management wants to be conservative, versus there might be certain earnings management choices which management is making in order to perhaps take higher losses today so that the management team can look better in the next period. It's very hard to identify that intent, and that is why often these items are bundled together. Next, we come to non-compliant accounting. Here, the quality of financial reporting is extremely low. In fact, it is almost non-existent. Information is being presented that does not depict economic reality, and numbers are being presented in a way that are not even following generally accepted accounting principles. A classic example is Enron in the late 90s. They engaged in complex transactions and then presented information in a way that made the level of debt appear much lower than it actually was, and the operating profits and cash flow from operations appeared to be much higher than they actually were. And finally, right at the bottom of the spectrum, we have fictitious transactions. So this is clear outright fraud in the sense that companies are reporting transactions that never took place. We now come to the concept of conservative and aggressive accounting. It is important to understand this material, and to do so I will create a simple example and then we will use that example to discuss several points. Let's say that our company has made some credit sales, and based on the collections that we expect, in other words, based on what we actually expect to receive from the customer in the future, our earnings in a given period would be 20. It is possible, however, that we collect less than expected, in which case earnings would be 10. And it's also possible that we collect more than expected, in which case the earnings would be 30. The question now is, what should be reported? Ideally, our financial reporting should be unbiased, which means that if the probability of each of these three is 1/3, then the unbiased number is 20. However, investors may prefer conservative accounting choices. In other words, here the conservative accounting choice would be to report earnings of 10. And why is it generally perceived that investors prefer conservative choices? The answer is straightforward. Investors would much rather receive a positive surprise than a negative surprise. If 20 is reported and then it turns out that collections are less than expected and the earnings have to be written down to 10, that would not look good and investors would be quite unhappy. It is generally perceived that managers prefer aggressive accounting because through aggressive accounting, management can report earnings of 30 in the current period and it will appear that the quarter was quite good. Aggressive accounting decreases reported performance and financial position in later periods. So if management does make this aggressive choice of reporting net income of 30 in the current period, and then in the next period the collections actually are such that the earnings should have been 20, so collections are less than the assumptions made here, then what will happen to earnings in the next period? Earnings in the next period would be lower. So that is the challenge or the issue with aggressive accounting. Conservative choices do not typically decrease reported performance and financial position in later periods. So the conservative choice of 10 would hopefully cause the earnings number in the future to be higher. Conservative means that the company is reporting a relatively low earnings number for the current period in the hope or expecting that if there is a positive surprise, if the amount of money collected is what was originally expected, then in later periods the earnings number will be better. The concept of conservatism is highlighted by the fact that there is a different degree of scrutiny associated with revenue recognition and expense recognition. When we are recognizing revenue, we only do so when the revenue is earned and we are reasonably certain of collecting the funds. This is when there is credit sales, such as what we discussed in the context example at the start of the slide. With expenses, however, we recognize them even when they are simply probable. Putting these 2 points together means that generally speaking, in the current period, the earnings will tend to be understated. Continuing with the same idea, I want to emphasize the fact that the conceptual framework supports neutrality of information. So what is this conceptual framework? You might recall from one of the readings early in the level 1 curriculum on financial reporting standards that the financial reporting conceptual framework is laid out, and there are several attributes of what a financial reporting framework should be like. Here, one segment of that discussion has been reproduced. The conceptual framework says that there should be faithful representation. Information that faithfully represents an economic phenomenon that it purports to represent is ideally complete, neutral, and free from error. Complete means that all information necessary to understand the phenomenon is depicted. Neutral means that information is selected and presented without bias. And that's a key point over here. So this is the ideal scenario. But as we've discussed, many accounting standards are conservatively biased. Conservatism protects contracting parties. To understand this point, let's consider a simple example where a company needs to borrow money from a bank. The bank is the third party or the contracting party. Obviously, the company has much more information about its earnings numbers and expenses relative to the contracting party or the third party. So the risks are higher for the bank and the information is lower for the bank. Clearly, if the earnings numbers are presented in a conservative manner, that would be safer for the bank. Also, conservatism reduces possibility of litigation. Going back to the simple example from the previous slide, let's say that the earnings numbers that could be reported in a given period are 10, 20, and 30, and say that a company goes with the neutral number 20. Later, for reasons outside the company's control, the collections are lower than expected and the company has to write down the earnings number, which causes the stock price to crash, and potentially then there might be lawsuits. Lots of angry shareholders will say that the company misrepresented information, and that can create an awkward situation for the company. To avoid situations like that, the company might simply conservatively report numbers, because if later on the earnings numbers are higher, that will not create any sort of lawsuits. Before moving on, let's just think about some accounting standards which are conservatively biased. The classic example is research, where any research costs need to be expensed, which causes earnings numbers to come down. Another example is litigation costs, and quoting from the curriculum here, when it becomes probable that a cost will be incurred, both US GAAP and IFRS require expense recognition, even though a legal liability may not be incurred until a future date. The final point on this slide has to do with bias in the application of accounting standards. Here, it's important for analysts to understand the intent of management. Let's consider a simple example. Let's say that in a given period there is some major restructuring taking place, and during this restructuring management incurs a lot of expenses, and during this time inappropriately writes down inventory as part of the overall restructuring charges. It might appear that this is conservative because the write down of inventory along with several other restructuring charges will cause earnings numbers to appear lower. But what if the intent of management is to look a whole lot better in the next period? By writing down inventory in this period and then selling that inventory at a much higher price in the next period, the earnings in the next period will look really good and management will get credit for that high earnings number. So clearly there is something wrong with this picture, and what has been described here is sometimes called cookie jar reserve accounting. This was done by Sunbeam in the 90s, and the company then got into trouble for such practices. As financial analysts, we need to understand the motivations that company management might have to present low quality financial information or low quality financial reports. If the motivations exist, then we need to understand what sorts of conditions are conducive to issuing low quality financial reports. And finally, we as analysts need to be aware of the mechanisms that discipline financial reporting quality. Let's start with motivations. One of the major motivations for company management to present low quality information is to hide poor performance. Let's say that the company is facing difficult economic times and the company believes that these difficult economic times are just temporary. What management might do is some form of earnings management in this particular period with the thought that the numbers will then improve in the future anyway. So simplistically, hiding poor performance is one motivation for presenting low quality financial reports. Another important one is to meet or exceed earnings expectations. This is particularly important for listed companies, where companies that are followed by investors or analysts will generally have an expected earnings number. So analysts will have their expectations about the earnings number for a particular quarter, and if it turns out that the reported earnings fall below those expectations, then generally the stock price will take a hit. Management knows what those expectations are, and in order to meet or exceed those expectations, they might manipulate or manage the earnings. A related item is to meet or exceed prior year results or some other benchmark. I mention prior year results because very often numbers are compared with the same number in the previous year or the same number in the previous comparable quarter. As an example, for let's say a company in a cyclic business, the earnings number for the fourth quarter in 2013 will be compared with earnings in the fourth quarter of 2012. Management knows that their reported earnings number here will be compared with the reported earnings number from the same quarter last year, and if there are certain expectations that this earnings number must exceed the earnings number from this quarter, management might try to manipulate the earnings. There might be career concerns and incentive compensation. So let's take career concerns first. Senior management would like the world to believe that the companies that they are managing are performing well. Let's take this one step further. Let's say that the CFO of a company is planning to look for employment at another firm. Obviously, what the CFO would like is to present good performance numbers at the company where he currently is, because this will help with his negotiation position at the next company. A related point is incentive compensation, where senior managers are often compensated based on the earnings numbers. So there is inherently a motivation to present high earnings numbers so that the bonuses are higher. Next, we move into conditions conducive to issuing low quality financial reports. Broadly speaking, there are three conditions which, if they exist, then the probability of low quality financial reports is very high. And the three conditions are shown here. One is motivation, that we discussed on the previous slide. Another is the opportunity to present low quality reports. And the third is rationalization. Let's discuss opportunity in a little more detail. Let's say that at a given company, the internal controls are weak. In other words, the CFO can find it easy to manage earnings. Related to that is an ineffective board of directors. As we see in the readings on corporate governance, ideally the board of directors should be keeping track of the numbers that are being presented. Let's say that the board of directors is weak. Perhaps the board of directors is very closely aligned with the senior management. Then that creates an opportunity to present low quality reports. If a company is operating in a region where the accounting standards allow a range of choices, then management might be tempted to use the standards that give numbers or produce earnings numbers that are relatively high or that meet what the managers want. Motivations we have talked about on the previous slide. And finally, rationalization. Those who are managing earnings will try to rationalize their behavior, and if a company is operating in an environment where it is relatively easy for managers to rationalize their behavior, there the probability of presenting low quality financial reports will be high. We now come to the mechanisms that discipline financial reporting quality. One of the mechanisms is the market itself. This is the market for raising financial capital. If a company is presenting low quality financial information, then the riskiness associated with that company will be high. In other words, investors will perceive this company to be high risk. If investors perceive this company to be high risk, they will value this company at a low level. In other words, the required return that investors will demand will be high. So this becomes very costly for companies. The cost of capital is high, and that is because the information being presented is low quality. So this in of itself serves as an incentive to present high quality financial information. But as we've discussed, there can be several conflicting incentives. So senior management might be more concerned with their compensation, so they would have an incentive to overstate earnings. Because of this, there is the need for regulatory authorities. In the United States, the regulatory authority is the Securities and Exchange Commission. And in fact, in every country where there are publicly listed companies and securities markets, there will be some regulatory authority. In India, for example, we have the Securities and Exchange Board of India. In Pakistan, we have SECP. In Hong Kong, we have the Securities and Futures Commission, and so on. Now, these regulatory authorities are members of an entity called the International Organization of Securities Commissions, or IOSCO. This is essentially an umbrella organization of the various regulators and also of other security market participants such as stock exchanges. But the IOSCO can also be thought of as the global standard setter for the securities sector. The actual regulation, though, will happen through the particular regulatory authority in each jurisdiction. So let's just take the SEC in the United States. The SEC is responsible for overseeing approximately 9,100 US public companies, along with investment advisors, brokers, dealers, and securities exchanges. According to the curriculum, in 2002, the SEC reported that it had filed 515 enforcement actions for financial reporting violations during the preceding 5-year period. It is important for you to recognize the typical features of a regulatory regime, and those are listed over here. The regulatory entity, such as the SEC, will generally have registration requirements. So publicly listed companies need to register, and there are certain registration requirements. Even private companies, which are private limited companies in certain countries, have registration requirements. There are disclosure requirements. Obviously, depending on whether the company is public or not, the disclosure requirements will vary. The disclosure requirements tend to be very high for listed companies. There are auditing requirements, so companies must be audited by an independent third-party auditor on a regular basis. Management is required to present a commentary on the performance of the company. There are responsibility statements. For example, in the United States, we have the Sarbanes-Oxley Act, and under this, senior management is required to submit formal certification that the information presented is reasonably accurate. And if this does not happen, or if information presented is not accurate, then the senior management is going to be charged with criminal offense. And if this does not happen, then senior management can go to jail. Regulatory review of filings. So the regulatory authority actually reviews the filings, and it's extremely important that there be some form of an enforcement mechanism. All these regulations will only work if there is a credible threat of enforcement. The role of auditors has been mentioned before, but it is important enough that it's being discussed again. Auditors provide third-party verification of financial statements. We've talked about auditors and the sorts of reports that they might present in other readings. Here, we just want to point out that even though an auditor gives a favorable view, that is not a guarantee that financial reporting quality is high. And we say this for several reasons. One reason is that the information that is reviewed by auditors is prepared and presented by the company. So the company gives information to the auditor and the auditor is reviewing that information. It is conceivable that the company presents biased reports or biased numbers to the auditor. Another point is that audits are typically based on a sample, and the sample might not necessarily reveal what is going on with the overall company. A third point is that there might be an expectations gap between the auditor's role and the public's expectations of the auditors. An audit is not typically intended to detect fraud. It is intended to provide assurance that financial reports are fairly presented. And the fourth point is that companies being audited pay the auditor, and that might create a potential conflict of interest. The final point on the slide has to do with private contracting, and I'll use an example from before. Let's say that we have a company that needs money, and this gets a substantial amount of money from a bank. The bank is, in a sense, the private contractor, and let's say that when lending money, there is this legal agreement that allows the bank to monitor the financial reports of the company. This will create an incentive for the company to produce high quality financial reports.